So, what we're going to do here is talk about something that is on the hearts and minds of people right now, if you have anything to do with real estate. And if you're listening to the news at all, things are going up. Inflation is here, folks, whether it's going to be temporary or long term. So, what we're finding out is that interest rates, to try to cool the economy off, the Fed is going to raise interest rates. And so people are saying, raise interest rates. Are you kidding me? I got to do something now. I don't want to pay extra. And they said, let me tell you something about this. All right. And get this. If you're clipping, you want to clip this. All right. It is easier to pay off your loans faster with a higher interest rate than it is with a lower one. Okay. So here's what we're talking about, folks. And this is what you need to understand. If you're in business, we need to ask critical questions. All right. We can go ahead and put the example on the screen.
It's
I've got an amortization calculator up here. And what we're doing here, folks, is we need to ask critical questions. Now, if you have a product or a service, all right, and you're selling that product or a service, and you have a price point for that product or service. Do you have 10 or 8 or 7 or 6 or even 5 price points for the same product? I mean, you're selling one. Do you have all those different price points for the same product? The answer is no. The bank has one product. One. They rent money. They're renting money, and they want to rent it for as long as they can, for as much as they can. All right. One more time. They want to rent it for as long as they can. You know what rent is? Rent is nothing more than interest on the money. All right. You know, we go from renting an apartment or renting a house, then we go to renting money our entire lives. So you want to get out of renting? Stop renting money also. We're going to show you how not to rent money for a lifetime. But anyway, back to the story. All right. So we're learning how that rent and interest on money is the same thing. So the bank says, I want to rent it for as long as I can, for as much as I can. They're there to make money. Am I anti-bank? No, I love the bank. So what you got to do is learn the rules so you're not renting money for a lifetime. You want to cut your interest cost, pay less rent, borrow your money at a discount, get it at wholesale, don't pay retail for your money. All right. So this is what we're talking about. So here's my thing. If you only have one price for your product or service, why does the bank have several prices for their product or service? Why does the bank come at you and say, if you want to save money, here is a lower interest rate, and here's what you have to pay to get that lower interest rate? Now, remember, we said the bank wants to, and we agreed that they want to rent it for as long as they can, for as much as they can. So why would they offer you anything that saves you money? Because if you're saving money, that means they're losing money. So my question has to be, if they're lowering the interest rate, what's in it for them? Because the banks, even though I love them, they're not beholden to us. The banks are beholden to their shareholders, people that hold stock in their company. And if you have stock in a company and you found out that that company was in the practice of cutting your profits by offering the product at a lesser price, you're not going to invest in that stock. So whatever they're doing, folks, makes them money, so the stockholders will stay. I want to show you some things. When it comes to amortized loans, it works practically backwards from what you think is actually going on. Everybody is trying to get the lowest interest rates possible. I'm just going to use this $100,000 example, okay? $100,000 example here, all right? At 6%, well, let me change it to 200,000, okay? Change it to 200,000. We can definitely find a house out there. We know that there's $200,000 mortgages, all right? Especially if they're rental properties. 200,000, 6%, 30 years. Look at this payment. It's $1199.10. $1199.10. Says, well, I can afford that payment because my rent was $1,200. My rent was $1,500. My rent was $1,800 or $2,000. So if I can get a house for $1199.10, I'm saving money. Plus, I have a house. But look at what's going on here, folks. They take a look at that 6% interest rate and they say, oh my gosh, look at this. $231,676. That's how much interest they want over 30 years. So anytime you're working with the bank, all right, anytime you're working with someone who is advising you on loans, anytime you're working with a loan officer, all of the information is going to be based on the term that they're talking about. And that term here is 30 years. Okay, so everything they're talking about is going to be in terms of 30 years. So you will pay, if you keep the loan 30 years, $231,676 in interest. That's more than you borrowed in principal. For total repaid would be $431,676. So that's one house for you and one house for the bank. How many of you are interested in buying a house for the bank as you're trying to buy one for you? Oh, no hands go up. Not many. All right, so here's what I'm talking about. What is it that is so important to point out about 30 years? Is because we don't want to pay the loan for 30 years. What if you pay it in 7 or 8 or even 9 years? What if you pay this loan off in between 7 years and 9 years? This $231,000 doesn't even matter anymore because you're not going to pay all of that interest. Well, why not? Well, how many of you have rented a car for a month? Have you ever rented a car for an extended period of time? And let's say you give you the price for renting the car for 1 month. And then you say, well, something happened and I have to give the car back to them after a week. Okay. So are they going to charge you 1 month's rent on the car? Or are they going to charge you 1 week? You're right. They're going to charge you 1 week. What if they tried to charge you 1 month? Oh, you'd raise, holy heck. Well, probably not the word that you would say. But listen, you say, absolutely not. I'm not paying you for a month. I'm returning the car. I use it for 1 week. I'm going to pay rent for 1 week. So if the bank said, you're supposed to pay us $231,676, that's over 30 years. If you keep their money that long, you will pay that interest. But what if you return their money after 7 years? Do you want to pay $231,000 in interest? Don't think you have to, because this is based on a 30-year term. This is not based on a 7-year term. Get that. Make sure we understand that part. Okay. So if we can pay a lot less interest by giving them back their money without affecting our budget adversely, oh man, now we're cooking with grease. All right. So here's what we're saying, folks. We're going to show you what's going on with this loan. All right. $199.10. And this is what people look at. $199.10 on the very first payment goes to principal. Look how much goes to interest. $1,000, $1,000 of your dollars. You worked hard for that money. And let me tell you what mortgage payment actually is. Mortgage payment is money that you actually borrow. Okay. You borrowed this money in the principal column. You borrowed this money, the $200 payments this particular family is making towards this loan. The interest payments is not money you borrowed. That's rent for having that money. That's rent on your loan. Okay. Those $900 payments, rent every single month.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.